Hi, I'm Jenny Brown. Welcome to this round of MFB Live. I hope everybody is keeping incredibly well. Thank you so much for joining us. And today we're going to be talking about essentially moving personally held property into a limited company structure. I'm delighted that we're going to be joined by Jason Wilde, who is National Sales Manager at specialist lender Paragon Bank, who's going to talk about us incorporating personally owned buy-to-let property from a lender's perspective. And then we're also going to be joined by Julian Sampson, partner and head of lending department at TWM Solicitors, who's going to talk us through the legal implications of the process. Now, first of all, just a very brief overview in terms of the process of transferring personally owned buy-to-let property into a limited company. Because there's a few kind of misnomers knocking around that I just want to put to bed straight away. So the first thing is, if you're doing this transaction, you're going to be using a mortgage, it needs to be documented as a sale and purchase transaction. So you can't simply move things across, transfer things, I think is the word that people often use. So what that actually means is that the property needs to be sold at a fair market value and paid for a full market value. And taxes need to be paid appropriately. So potentially as a seller of the property, as in you're selling your personally held properties to a limited company, you could be liable for capital gains tax. And as the limited company buying the property from you, there would be stamp duty to be paid. Now, there is some processes which can be used, which can defer these payments. This is something that you very much need to get specialist tax advice about. And you're going to hear this echoed, I'm sure, throughout the course of today's discussions. But, you know, fundamentally, it is a sale and purchase transaction at market value. It isn't simply a transfer. Now, the other thing that often gets talked about is the kind of mortgage process of doing this. So say, for example, you have a buy-to-let mortgage in your own name, and this is a mortgage with Birmingham Midshires, and you want to move the property, sell the property across to a limited company. Birmingham Midshires do not lend to limited companies. So by virtue of that fact, they're going to have to approach Birmingham Midshires. You would ask them, I want to make this transaction, could you lend? They're going to say no, because we don't lend to limited companies. So what you're going to need to do is take a new mortgage, which would facilitate the acquisition of the property from yourself into the limited company, almost as if you're buying it from a total stranger. Now, there are some exceptions to this, and I suspect once we start speaking to Jason Wilde, you will find out a bit more about how not all lenders would expect redemption of their loan, but it is a minority, not the majority. So like I say, my first guest today is the National Sales Manager for Paragon Bank, Jason Wilde. Now, he initially started his career as an estate agent in 1997 and trained as a mortgage advisor in 2001, specialising in buy-to-let before moving over to working for lenders. Jason joined Paragon in 2007, and he's seen all the housing market fluctuations and policy and fiscal changes since then, and my word, there have been a lot of them. An expert in this field, he speaks at many events in the buy-to-let market, limited company lending, incorporation, HMOs, are things that he talks about incredibly well. So we're really delighted to welcome Jason Wilde with us today.
Jason, thank you so much for joining us today. We're delighted to have you here on MFB Live. So today we're focusing on incorporating a portfolio. So what we mean by that is not simply selling a single buy-to-let to a company, but where people will be moving multiple properties across at once. Are you able to give us an overview of how this actually works in practice?
Yes, I can. Yeah, I'm going to state the obvious here, but I do feel it needs saying, and I'll probably say it multiple times. I mean, the first protocol for anyone looking at doing this is to seek professional tax advice on the back of it. You know, there's lots of information online on various forums and stuff, but seek professional tax advice for your own personal circumstances. We do see this a fair amount where borrowers have been looking to incorporate their portfolios, and obviously it's all started on the back of the Section 24 tax changes that have come through. So invariably, what we have seen, we've seen kind of over the years, you're kind of one or two, properties that have been kind of incorporated across. But what we've seen a big drive towards are perhaps some of your larger landlords that are moving across, and some of the feedback that we get from cases that come in when we're speaking to the introducers and the borrowers and their tax advisors is that some borrowers are qualifying for Section 162 incorporation relief. Now, to kind of just touch on that briefly, what they're looking at doing is they're running a portfolio. So, for example, it could be Mr. and Mrs. are running a portfolio. You could be talking about 3, 4, 5+ million pounds worth of property. So they've been running that portfolio, and the tax returns have just been done in their personal names. Now, what we've been seeing, and again, I'm not saying this is right for everyone, but what we've been seeing is borrowers then saying, okay, to qualify for this Section 162 incorporation relief, I need to run this portfolio as a partnership for 2 years. So what they've been doing is, effectively setting up a unique taxpayer reference code, still declaring the rental income as they would, but it would have been Mr. and Mrs. in terms of their partnership that's actually declaring the rental income. And once they've got 2 years worth of partnership returns, they can then incorporate the whole portfolio through to a limited company. And again, this isn't advice from our side of things, but what we've seen, and this has been one of the attractions that we've picked up feedback from borrowers and brokers and accountants, is that borrowers who qualify for the Section 162 incorporation relief, where they've moved from individual to a partnership and then incorporate to a limited company, it appears to be a fairly tax efficient way of doing it in terms of stamp duty and potentially rolling up the capital gains in the shares going forward. So the long and short of it is we have seen a fair amount of it. Our understanding again is that if you're going to incorporate the portfolio, the whole portfolio needs to go on the same day. So one thing to take into account on the back of that is that if you're placing your portfolio with multiple different lenders, it's a case of, all the legal teams need to be, in sync to ensure that that all happens on the same day.
Yeah, okay, thank you. And so what I'm sort of hearing here is that actually getting some really solid advice from a tax
Absolutely.
person is really, really important.
Yeah.
Keeping in mind the complexities if you're using lots of different lenders on your incorporation and timings. What other things do you think landlords should be wary of when they're embarking on this process?
I guess the main thing is it's not for everyone. I did touch on it earlier. I think it's quite easy, and obviously some forums can be very interesting, seeing what other landlords are doing. But certainly it's not for everyone. And the one thing I would stress, certainly working for a lender, and I'm not sure if you'd echo this, Jenny, is that by all means, before you proceed with mortgage advice, get the correct professional tax advice. But our advice is before you proceed with any changes to your portfolio, whether or not it's existing, anything to do with your tax structures, certainly speak to your advisor, because the last thing you want to do is do something that your tax advisors advise you is highly tax efficient, but yet you find that 4 or 5 different lenders, maybe the market leading lenders, aren't particularly happy with the way you structured that. So we have seen a bit of that over the years, where borrowers have gone down the route of changing their ownership structures and then realizing when they then come to finance or refinance those, that some lenders aren't necessarily happy with the way they've structured things. So my advice would be get advice from both sides, from a taxation, but also from speaking to your mortgage broker.
Yeah, absolutely. I mean, these things all kind of link in, don't you? And I know one of the things that we have seen, which quite a lot of landlords have gone down the route of, is BICs, beneficial interest corporate trusts.
Yes.
And I know that while they're very tempting to people because of the kind of tax advantages they can bring, but I know as lenders, there is no lender at the moment who actually sort of really likes the idea of one of these in the background. So that's why I say it's really important that you kind of talk to everyone that's going to be involved in the process. So thank you for that. Now, in terms of, at Paragon, you're taking on an incorporation application. So what sort of things are you actually looking for as part of your underwriting process and due diligence?
So from our point of view, we're just looking for the bones of how the deal is going to be structured. It's a change in legal entity, so it would go through as a purchase. So from the lender's point of view, we're ensuring it goes through at full market value. There's going to be questions as to how deposits are going to be accounted for. Now, lenders in general aren't expecting the borrowers to be putting their own deposits in. They know more often than not that the equity built up in those properties will be accounted for as a deposits. But how's that going to go through? Is it going to go through as director's loan, share issue, etc.? So from a lender's point of view, it's just getting an overview. And often, what we have asked, certainly intermediaries that we deal with, is just get us a small paragraph from the accountant saying, this is the way that we're looking at structuring this incorporation going forward. It certainly helps us out from that side. Ideally as well, we want to see the applicants who are involved in our application mirror the current ownership structure.
Okay, that makes sense. And another thing actually that we often find people aren't aware of is that some borrowers don't realise that when they want to switch their mortgage across when they incorporate, their existing lenders may not allow them to do this. So not all lenders will allow you to, mid-product term, for example, switch across from personal to limited company ownership.
Yeah.
And therefore, the borrowers are sometimes a little bit caught out there faced with the concept of having to pay early repayment charges. Are you able to explain why some lenders may take this policy, and also just sort of give us an overview about where Paragon sit on this particular point?
Yeah, absolutely. I think it all comes down to the fact that it is a change in legal entity who own the property. So it's going from personal name through to limited company. So you find that, in terms of some lenders, they say, well, actually, we can't lend to this limited company. You'll find that some borrowers will have portfolios with lenders who aren't lending to limited companies, for example. So I can only assume that that's the way that some lenders have viewed this and effectively saying, look, if you're going to incorporate it, you need to redeem this loan, take out a new loan, and therefore you're going to be liable for any potential ERCs. No, at Paragon, it's slightly different. Now, we've been around pretty much since day one in terms of buy to let, and incorporation's been very popular over the last couple of years with the announcement of the Section 24 tax changes, but we have seen incorporation over the years anyway. So we've kind of got comfortable with the fact of anyone who has a mortgage with Paragon during their fixed rate, whether or not they're 6 weeks into their fixed rate or 2 years into a 5-year fixed rate, we're happy allowing them to incorporate into a limited company, providing the ownership structure stays exactly the same. Now, where that works quite well for us is that 5-year fixed rates have obviously been quite popular over the last couple of years. And certainly what I touched on earlier, anyone who's qualifying for the Section 162 incorporation relief, bear in mind you would potentially need 2 years worth of partnerships returns before you can actually qualify for this. So what we're finding is that cases are coming to us on a remortgage basis. They're taking out a 5-year fixed rate with the full intention of incorporating that through to their limited company ownership during that fixed rate period. Now, from Paragon's point of view, there's no difference in the rate. We're not loading the rate, charging any additional fees. Obviously, it still goes through as a purchase transaction from HMRC's point of view, and obviously what the clients are doing in terms of their taxation is down to them and their professional advisor. But from Paragon's point of view, the terms stay exactly the same mortgage account number, same rate. There's no change on that side of things.
Brilliant. And actually, for all the people that are watching this, I can vouch that Paragon do really make good on that point. I've actually seen them do it, and
Okay.
it's a very, very unique thing. So, yeah, it's quite incredible. So, look, if someone who is watching this now is thinking about incorporation,
Yeah.
what advice would you give to them?
Well, first of all, stating the obvious is to seek professional tax advice. I think what you also find in the marketplace, certainly within tax advice, you find that there are some advisors, tax advisors, who specialise in property. We've had conversations with some accountants, tax advisors who are landlords themselves, and they're really kind of focused on this end of the marketplace. So our first advice would be to see or see a professional advisor, get that tax advice. Whether or not you stop at just one person or whether or not you go and speak to, sort of 1 or 2 tax advisors, it's certainly from our point of view would be the first port of call. Secondly, we'd obviously then be going to speak to an intermediary. Look, I'm here talking about Paragon, but we're aware there are multiple lenders out there who lend in limited company marketplace. So really to find who's got the best products for you. And again, I touched on this earlier, it may be a case that you end up splitting the portfolio. There may be some properties that are suitable for one lender and other lenders are happy to take on others in certain areas. So certainly make the most of speaking to professionals on the tax side, but also on the broking side of things. It's vital.
Perfect. Okay, so thank you, Jason. That is absolutely brilliant. We're just going to move away from incorporation now and just talk more broadly about the private rental sector. So I do genuinely believe that Paragon as a lender are, very, very experienced. You really do understand the buy-to-let mortgage market, but actually you're very much aware of kind of the private rental sector as a whole and aware of the challenges that landlords are facing. I think you actually are real champions of the landlord.
Mm.
And I'd love to hear any kind of advice or pearls of wisdom you have for landlords for the coming 12 months, the various changes that they have coming their way. And I'm going to give you some extra points if you can give us some thoughts and call accurately what base rate is going to do as well.
Thank you. Okay. Great. Yeah. Thanks for the question there. So look, landlords, like most people, we're going to need to see an increase in costs, certainly over the next 12 months, and who knows, going beyond that. But we're confident as a lender that landlords are robust enough, to see out any of these increases. It might be challenging for some, but we're confident that it's still going to be a good marketplace to be. Let's be fair, there still aren't enough properties to go around. So the demand for rental properties is still sky high. And we expect it to continue that way. If there are any landlords, and feedback that we see is there aren't a huge swathes of landlords, as you may see in some of the press, leaving the marketplace. If there are any landlords disposing of properties, that's going to be potentially less stock on the market, which naturally is going to increase demand and potentially increase rents going forward. Challenges you're up against kind of going forward, kind of on the horizon, you've got the proposal about EPC changes, which by 2025, again, these are only proposals, but it's expected to come in. The only thing we're not sure on yet is the exact dates, but the proposals at the moment by 2025, new tenants should have a C rating or above. and by 2028 that should be for all tenancies. So the one thing we would say there is, look, if it is coming in force in 2025, that's not a million miles away. So start looking at your portfolios. Again, one thing that we're having conversations with brokers about on applications that come into us is, when was the last time your EPC was carried out? If you've got an EPC on your property that's maybe 8-9 years old, an up-to-date EPC, if you're all of a sudden qualifying for an A to C, potentially you could be applying for a cheaper rate with lenders. Lenders like us, and there are multiple lenders out there, are actually offering slightly lower rates for those properties that are rated between an A to C rating. So again, if you haven't got an up-to-date EPC, it's well worth going down that route and potentially looking at it. In terms of base rate, that's the eternal question here. I think the key driver is going to be inflation, and until they can get that under control, it does look like rates are going to continue to increase. The thing is, we don't know where they're going to top out. But one thing that we do look at from a lender's point of view, and every lender will be looking at this, is what swap rates are doing. We're in a very unusual circumstance at the moment that you've got 2-year swap rates. So swap rates are effectively the way that lenders will price up their fixed rates. So two-year swaps will be what we're pricing our 2-year fixed rates on. So the 2-year swap rates are actually higher than 5-year swap rates, and 5-year swap rates are actually higher than 10-year swap rates. So when you're looking at that there, the swap rate market will tell you that they're expecting the base rate in 2 years to be higher than what they're expecting it to be in 5 years, and ultimately within 10 years they're expecting it to be lower. It's not an exact science, but it's a fairly good gauge that you find that lenders will work on for there. But in terms of plucking a figure out the sky, I'm going to duck my bonus points on that, because who knows where it's going to end up. Look, the European Central Bank, I think last week, raised it by 0.75. So like I say, the key driver to all of this will be inflation. Until they can get that under control, we're at potential risk of further increases going forward.
Amazing, thank you. And I think just kind of looping this back to what we've been talking about, and we're seeing as a business, and I'm sure Paragon are maybe starting to do the same thing also, that we had landlords after Section 24 was announced, where they considered incorporation.
Yep.
But the mortgage interest rates they were on were super low. They had these old mortgage express trackers and all the rest of it. Yeah. And they've held off. But now actually interest rates are going up and they can't affect that. They can't control that. So now what they're doing is revisiting how else they can save costs, and actually incorporation and actually bringing down their tax bills potentially is something they're really looking at. So yeah, I'm sure this will be really useful to lots of people who are really weighing up their options at the moment. Jason, thank you so much for joining us. I know you're a super busy chap, so we really do appreciate your time. Thank you for coming along.
Thank you very much.
So my next guest today is Julian Sampson, who's partner and head of lending department at TWM Solicitors. Now, Julian represents national and global lenders and services and has worked extensively for borrowers restructuring property portfolios. A true expert in his field, Julian has a wealth of knowledge about the legal implications of limited company ownership and incorporation. And I can actually personally vouch for this, because Julian has worked with some of my clients in the past, and the absolute depth of his knowledge and experience is absolutely incredible. So we're really, really grateful that Julian's been able to give some time today to join us on MFB Live. Julian, thank you so much for joining us today. It's lovely to see you again. I hope you've been keeping really well. Now, look, as you know, we're largely talking today about incorporation. So with that in mind, we know that for some landlords, so using a limited company as their investment vehicle could be advantageous from a tax perspective. And many landlords are opting to make new acquisitions using a limited company. But how about for those properties landlords already owned? Are more landlords transferring existing buy-to-let property from personal to limited company ownership? And if so, is it a complicated process?
Thanks, Jen. It's lovely to be back on screen with you again. So it's and thank you for the invitation. I mean, it's an interesting decision-making process for what we're discussing here about the incorporation of a portfolio. And as with any fundamental business decision, obviously the client is hopefully involving yourself, talks through to us, talks to their accountant and or tax advisor, or someone that wears all those hats at the same time, because this is really should be a collective decision. But I think we are seeing probably a steady level of incorporations at the moment through the door. But I think that's not necessarily a sign of it being more popular today or less popular today than it was last year. I think this is quite often they are planned for a period. So this whole aggregation of the advisors has been happening for some time beforehand, and there are many people who are incorporating over a 12 to 18 month period getting their structuring right. So this goes back to obviously what we're talking about, the complexity, because if this decision is made and, you know, people have accumulated a portfolio over a number of years, they may not have had the end game in mind when they bought their first 4 or 5, for example, that a Section 24 was coming, or was on its way through, and or that this is where they wanted to be. Many obviously don't think they were going to end up with 30, 40, 50 properties. It's kind of as sometimes as accidental as it is deliberate. So where the people have starting off in a position that is probably unfavourable to incorporate, they take 12, 15, 18 months to get houses in order, to start the process of building, for example, a partnership structure, whether that's a general partnership or limited liability partnership, to start bringing some commercialization from a corporate perspective into their arrangement, before they then look at the final stage, which is the incorporation into limited companies, and then the refinancing that will frequently come with that, with, you know, people like yourselves who will then be able to say, okay, as a group now of a group of properties, this is where we're looking to place mortgages and finally tip over into that final incorporated proposition. So I wouldn't say there's a massive rush now than there ever has been, but what we do see is a lot of work having gone on in the background that suggests that there is a constant communication and conversation being had between borrowers, advisors, probably from a time perspective, as it's come to the end of certain key rates on some of their portfolio, where actually it's the advisors and brokers like yourself who have said, actually, these are opportunities that we need to be identifying in 1, 2, 3, 4 years. Let's have that conversation now. So what we are finding, I suppose, is more conversations being led by brokers who are aware of the opportunities, because they are the ones that have, I guess, the timelines in the back of their head as to when is an appropriate time to refinance, which gives you the opportunity to trigger that portfolio incorporation free of the existing debt and starting afresh with a new specialist lender. So it's always trickle busy, but but when they come, it tends to be like herding cats. So there is complexity, and there are a lot of moving parts to it. It's not just all sitting there and drafting wonderful documents. Half of it is just practically trying to get the clients organised, and so the arrangement seems to be almost seamless, whereas we all know it's often not.
Yeah, they can be very, very complicated, actually. The ones that we've transacted, some have been quite straightforward, but others have been, like you say, many moving parts involved. And so there's lots of different bits to it. One of the things actually that we were wondering is, because I think a lot of landlords, when Section 24 was announced, looked to set up the journey of incorporation and ultimately then incorporated. But a lot of landlords, I think, were kind of reticent to do so because they see it as quite a costly exercise in terms of obviously sort of legal advice, the kind of things that sit around the edges, and also the mortgage interest rates are regarded as being higher for limited companies. So I think as people have been enjoying low personal borrowing rates, they've been able to really kind of think, well, okay, the tax is rubbish, but at least I'm getting a cheaper interest rate. Whereas now the interest rates have gone up, I think we may see potentially coming up a second round of incorporations where landlords have been forced to consider their tax position because they can at least control that to some extent, whereas they can't control interest rates. So maybe we'll see a new wave coming in over the next few months and years. Now, in terms of when landlords are thinking about potential incorporation, what things do you think they really need to consider, and what should they be keeping in their mind as points to really deliberate beforehand?
Well, I think, first and foremost, it's, is it right? Don't do it unless, as you clearly pointed out, there's a fixed cost in incorporation and a fixed cost in potential tax liabilities, which hopefully, as working with the advisors, you try and mitigate that as best you can. But all of these are fixed costs. And if you have a structure at the moment that does not provide for incorporation particularly easily, then is the saving you make when you refinance onto an alternative rate, is that simply over a period of time going to cover the one-off fixed cost in the incorporation itself. So, you know, for many people, it's not right. However, the people who have obviously more sizable portfolios, but certainly a more sizable proportion of those portfolios that are already in some sort of partnership or as you say, this incorporation journey, then often the opportunity to then tip into the incorporation is something that is probably right. The tax implications can probably be mitigated because of the planning that has gone on beforehand. So all of a sudden, it comes the initial capital hit is minimised. There are legal costs that flow from it, and I'll touch on those in just a wee bit. But really, it then becomes a decision about are all your rates coming together at roughly and collectively the same time, so you're not getting hit by any particular repayment penalties that are coming through across your portfolio, because of course you've acquired these properties over a number of years, and the whole point about doing a successful portfolio incorporation, with the odd one or two exceptions, is that it all comes together at the same day, essentially. And so again, your current financing has to be in a similar situation to your corporate structuring, i.e. it's ready to hit that tipping point for you at that time. I think from a legal cost perspective, this is a well-trodden path. So from our perspective, there's obviously the standard mortgage conveyancing costs. There are the costs involved in the transferring of assets from one entity, the general partnership, for example, into the limited company. The one thing I would be wary of, and it's you know, we see it an awful lot, is what schematic is being used to make this incorporation. And I say that from a pure cost perspective because I'm aware that there are plenty of advisory firms out there who will charge a percentage, for example, of the tax having been saved or arguably saved in an incorporation. So you may find that there are fees that have been accrued for several £1,000s for what is actually a relatively simple legal exercise that should be done, from my perspective, on a time cost basis, rather than supplemented or a premium paid, because the tax advice is dependent on almost a success fee basis. So the borrower should be careful about where their advisors are coming from on that front as well.
Okay, great, thank you. In terms of the kind of, so when we're talking about incorporation, I think it's probably just worth rewinding slightly. So what we're talking about is where essentially it's not just I have a property in my own name and I'm going to sell it across to my limited company. I mean, that is a sale and purchase transaction in the sort of purest sense of the word. What we're really talking about here is a kind of well planned and organised transition of ownership from personal via a limited company, partnership structure, aren't we, into limited companies, which is regarded as essentially proper incorporation. Yeah, so that's, I just wanted to, I suddenly realised that we haven't probably touched on exactly what we're referring to when we say incorporation, and therefore the why the costs, there's savings to be made in terms of taxation, but likewise there's much more legal complexity that sits around it. And actually, just to touch on a couple of the things that you mentioned a short minute ago, is that the requirements for incorporation in this context that we're using it, so it does have to happen all at once, generally speaking.
Yeah, it's a given that it happens all at once. There are occasions, we talked about herding cats previously about how you manage it, but there are occasions when you can set up an agency structure around some of the properties that are overhanging, so that it doesn't have a direct impact on the effect of the incorporation. So the incorporation happens in relation to essentially the beneficial interest, the right to receive profit from rent and from the property, and the legal mechanics of transferring. And that could be for any number of reasons, but typically it's because, for example, a redemption statement hasn't been received from an obscure lender who takes an extra 7 days than you're anticipating to send it across. From personal experience, you can tell. And you suddenly have 40 properties all incorporating in one day, but one overhanging. So what you need to do is set up agency agreements and trusts to ensure that doesn't bring down the house of cards of the other 39 that are supposed to be coming across. Because, you know, I think we all have to sort of accept that we're the best one in the world. We love it all done in one day, but we all know from experience that sometimes anticipated completion dates are always met on the day we all
really.
Post.
Yeah, so that side of things, and I suppose that really kind of illustrates why it's really important, first of all, getting proper advice from tax people in terms of setting it up, but also once you come to execute the incorporation, actually having a really experienced legal team working on this for you to make sure that the house of cards doesn't come tumbling down is just so incredibly important. And I suppose really just carrying on from the kind of theme of legal advice. So obviously we know that people like to use limited companies from a tax perspective, but are there any kind of additional legal advantages to a landlord for using a company structure?
Yeah, of course. So I mean, and this applies not just for, as you say, for the incorporated portfolios that we're discussing, but also for that single landlord starting their journey and saying, actually, it is more tax efficient for me to go to buy my first property in a limited company. So these sorts of underlying benefits apply as much for that person as it does for the person who's incorporating a whole. The most obvious one is funny enough, the one that's least often thought about, which is succession. So within a limited company structure, there are obviously shareholders, and those shareholders can be minors, i.e. people who are, say, children of the landlord, and that can be a good way of getting an investment or a portion of the limited company investment starting its way, if you like, for your successors, your children, to eventually take a larger controlling share interest in the company, which owns the underlying assets. So in that respect, the limited company that owns the property never changes, of course, but the underlying ownership does. And as long as you are in a position to work with your broker to ensure that you're not giving someone a majority or a controlling shareholding, then that will hopefully benefit the long term generally as part of from succession perspective. I think the other point to think about is not just succession, but is also isolating liability. So the whole point of having a limited company, as the name suggests, it's limited liability company, and typically you are limited to the extent of your share capital. Of course, more lenders tend to want to have personal guarantees, so that kind of mitigates that as a proposal. But there are other contracts that you as a limited company might enter into where there is typically a limit of liability to you as a person beyond that you might want to limit. So isolating liability. You have a variety of different structuring options within a limited company. So if I am a landlord who's also an investor, for example, I buy a property that's one up, one down, and I want to convert it into 2 flats on a buy-to-let basis. If I have a limited company and I can then create a subsidiary of that limited company, I can then grant a lease from myself as limited company number 1 to limited company number 2, and in doing so, because they're different legal entities, the land registry don't have palpitations about that. And similarly, I'm also then isolating the liability of the mortgages of the whole between those 2 SPVs, because lender 1 will lend to SPV 1, which owns flat A, and then lender 2 will lend to SPV 2, which owns flat B. And in that way, I am actually benefiting from creating 2 units from 1, but I am isolating my liability to each unit. And on top of that, I haven't actually, if done properly, in doing so, I haven't actually created any inherent tax liability or capital tax liability like stamp duty, because I'm using the reliefs that apply between a holding company and a subsidiary, for example. So it gives these group options, gives you lots of flexibility. I guess it's like having a very large family and asking each member of your family to buy a property individually. But of course, ultimately, families do sometimes fall out with, I suppose, at least the benefit of having a group company structure is that SPV 1 doesn't really mind what happens with SPV 2, say that they are in the same group structure and obliged to look after each other. I think, you know, we will touch on a little bit about some of the things in relation to funding limited companies. But the other obvious thing to say is that limited companies can lend to each other. So they are disconnected from a liability perspective, but at times they can also contribute to each other. And often we'll see funding arrangements where limited company 2, which might have a strong cash position, might lend money, even if it's a paper loan agreement, to company 1 to be able to buy another property. And so that way, you know, it bizarrely, even though they're very limited companies, very fixed structures, they actually give you a lot more flexibility and there's more fluidity if you think about it properly. So there are plenty of options beyond the obvious ones for limited company, and the obvious one being obviously tax relief and the ability to claim various expenses along the way.
Loads of great reasons to use limited companies beyond the tax. Thank you, Julian. And I think probably just my last big question for you today is, there's obviously a lot of complexity that sits around limited company lending. From a conveyancing perspective, do limited company applications actually take longer than personal ones, do you think?
I mean, yes, they do simply. I mean, but I wouldn't say by much. And I think that the issue that we see is, I guess, novice landlords who haven't incorporated or had experience of an SPV. There's a lot more. There is a lot more documentation flying around there. We've talked about personal guarantees, but I mean that's a really obvious one, where you have to explain to somebody that, you know, the company that they own and they wear that company hat very well is a separate legal entity to them as a private individual, and that sometimes takes a bit of time to get your head around. So there's an obvious one there, but from a conveyancing perspective, we find the explanation of that to a landlord can be quite painstaking, but worth it if we can get it right first time round. And then if we're acting for the lender only, there are often times where we have a borrower's solicitor who is a conveyancer in the normal sense of the word, who doesn't get involved in limited companies typically, and we have sort of plenty within our firm and people in the market generally, who will act for private individuals on a sale and purchase, and this is the first time they might have come across a limited company. And so again, trying to explain to another lawyer why we're doing what we're doing, and we assume certain levels of knowledge, but it doesn't always work that way. This can also be quite frustrating. So there's a lot of mansplaining that needs to be had, unfortunately. But I think, you know, from my perspective, if a borrower can be comfortable with their own constitution and the way that they're structured, so the number of directors, number of shareholders, whether the majority shareholders, it might therefore have an impact on what the underwriter is going to look at. But also, if the other side of the scale is if we have a single director of a company, there is a case came through in March called Hashmi, which has done a big impact on conveyancing, and lenders generally a bit worried about it, which is where there is actually a conflict between the Companies Act and the model article, which is essentially the constitution the company accepted when you buy a company online and you hit, yes, I'll have these model articles. As the name suggests, it's the company constitution that just gets thrown at you. There is a conflict between the Act and the model articles in relation to what's called a quorum, in other words, the amount of people you need to make a decision. And the Companies Act allows decisions to be made by a single director, fabulous. But bizarrely, the model constitution suggests that actually to have this quorum, you should have a minimum of 2 directors. So if I'm a company, own a company, and I'm the sole director, in theory, each of the management decisions I make is what's called ultra vires. In other words, I cannot make it for the company, and therefore any decision I make to enter into a mortgage could potentially be unwound. So it's a very exciting legal point. Everyone's very excited in law land, but explaining that to a borrower is somewhat slightly different. It just adds another layer of complexity where we have to investigate and interrogate the constitution a bit more and make some amendments to that. But I think as long as the borrower can be comfortable with their constitution, whether or not they have historically granted floating charges or debentures over the property, means that there is additional hurdles that we have to go through. But with an experienced lawyer on side, it tends to make it a little bit easier. And it is, I say, a well-trodden path from our side. So it should be something that shouldn't have too much extra layers of complexity to the borrower.
Julian, thank you so much for your time today. That really has been so informative. And for anybody who is watching us today, if you did want to make contact with Julian and his team at TWR, as you can tell, are incredibly experienced, you're very welcome to contact us and we can share details. Or if you go onto the TWM website, Julian's based in Guildford, his contact details will be on there again. Julian, thank you so much for your time and we'll see you soon.
Take care.
That was incredible. So thank you again to both of our guests for their time. The knowledge between these two gentlemen is absolutely incredible, and I found some of that really, really interesting. It just goes to prove that having been in the role for Mortgages for Business 15 years, in the industry for 25 years, you can still learn things. Now, I just want to apologise. I believe there's been some technical difficulties experienced this evening, so I hope you've still managed to at least hear. That's the key thing. Lots of fantastic information, but if there is anything that you couldn't quite catch, and you want to give us a call to ask those questions, please do just get in touch. But absolutely apologies for this. Again, we are going to be sharing recordings of the webinar as well. So actually, if you want to get in touch and maybe re-watch the webinar, that way that might help you also. But so sorry, these things are always a little bit tricky when you were doing them this way. Now, before I go, I wanted to answer some of the many questions submitted by viewers ahead of this evening. I'm afraid I can't answer any tax-related questions. It really is for someone who has a far higher pay grade than I do. So if you do have tax-related questions, what you really do need to do is find yourself a really good tax advisor, and they're going to be able to help you with those. However, there are some other questions which I can answer, which are within my remit, and I'd love to be able to help you with some of those. So first of all, Susan has asked, how much would it cost to transfer personally owned properties into a limited company? So I think, you know, what you would have gleaned from today's discussions is that there is going to be potentially a cost to yourself in terms of capital gains tax. And then when the company buys the property, you're going to be looking at stamp duty land tax as well. And don't forget, there's a 3% surcharge. One of the things we get asked often is, if it's the company's first buy-to acquisition, is there a stamp duty land tax charge of surcharge of 3%? The answer is yes. As soon as you involve a limited company into the process, there is always a 3% surcharge is payable. In terms of other costs, so look, you know, there's going to be the normal mortgage arrangement fees, so potentially valuation fees, arrangement fee, depending on which company you're using, there could be a broker fee, so all the kind of standard mortgage charges. But I think from the sense of kind of yourself, they're the kind of key things. The other thing just to bear in mind, when you sell a property personally to a limited company, as we've said sort of numerous times today, separate legal entities, it's a sale and purchase transaction, so you will need to have a solicitor acting for you as the seller of the property, as you would if you were selling it to a total stranger. And a limited company will need to have a separate solicitor, so two different solicitors representing the limited company and the lender on that side as well. So it really is two sets of solicitors here, so that's an additional cost that not everybody is aware of. Now, Richard has asked, what added complications, if any, are there if the individual owner is an expat seeking to move ownership to a limited company? So I think Richard, it's a really great question. There are less lenders who want to lend to expats than there are people who are UK resident. The great news is that lenders who tend to lend in the limited company space largely tend to be the more specialist lenders. And by this, we're talking about people like Fleet Mortgages, Foundation Home Loans, Keystone, Paragon, Shawbrook, and many, many more. These guys, because they're specialist lenders, they are able to do the more kind of quirky transactions. And actually for these guys, lending to expats is also generally, not for all of them, but for a chunk of them, part of what they offer. So actually, yes, you know, you will find there are going to be less lenders who would lend to you from that perspective of your expat status. But actually, there's still going to be lots of choice for you. Beyond that, in terms of added complications, in terms of the processing of the actual sale, I can't imagine there would be too many difficulties. I'm guessing getting things kind of certified overseas might be slightly more cumbersome. You might have to pay a notary, for example, to certify documents. But by and large, it should be very, very similar to if you were a resident onshore. And that is all we have time for this time around, I'm afraid. So thank you so much to all of you for joining us. I hope you found this MFB Live really, really useful. I know that I've certainly learned a thing or two from our wonderful guests. And on that note, thank you so much again to Julian and Jason as well. If you have any questions, you're very welcome to give us a call 0345 345 6788 or email us at inquiry@mortgagesforbusiness.co.uk. Obviously, if it's mortgage related, we'll be very happy to handle it. But if you have something you'd like to ask Jason or Julian, we can route your questions onto them directly as well. That's no problem at all. So what's left for me to do is really just, first of all, say that if we didn't get a chance to answer your questions that you sent in advance of today's MFB Live, we will be contacting you directly to respond. So sorry we didn't get around to answer absolutely everything. And like I say, if you do have anything you want to discuss, we'd love to hear from you. Incidentally, if you do have any suggestions or thoughts about subjects that you'd like us to cover off for the next MFB Live, we'd love to hear. It's all very well us picking subject matters which you think are going to be interesting, but really this is for the benefit of you guys to let us know what would be good for you, and we'll certainly work around that where we possibly can. Do take care of yourselves. Thank you again for joining us, and we will catch you next time around.